It used to be the case that only the very wealthy could afford wealth management. But of course, now that's no longer true. With the advent of robo-funds, there's been a democratization of wealth management. How have they done this? Well, they can reduce costs by automating the process of matching a person's risk appetite to a portfolio and also managing the assets inside that portfolio very cost effectively. All of the funds we're about to see are fairly similar in how they operate. They all buy very cheap funds. That way they can keep their costs down, and they use automation wherever they can, again, to keep costs down. But how do they compare? In fact, there is quite a bit of variability in their fees. So let's see how much they charge. A good place to start is to ask, what can you control? Can you control the markets? No, you certainly can't. Or at least not legally. So we can't control markets, but we can choose a good fund manager. But what we can't control is the performance of that fund manager. Today's star might be tomorrow's washout. What we certainly can control is the amount of fees that we pay. So what we have to ask ourselves is, how do funds make money? And here robo-funds are no different from normal funds, but their selling point is that their fees are low. Let's just remind ourselves how funds work. You and I and a group of investors pool our money together, and our money goes into a fund. That fund is managed by a fund manager, which can either be a human being, or nowadays it could also be a computer algorithm or a robot. The fund manager buys assets, and if they do their job well, those assets generate a good return. That grows the size of the fund, and it increases the wealth of the investors. In return, we pay a fee to the fund manager. And indirectly, we pay for the funds that were bought by that fund manager. We may also have to pay transaction fees as they buy and sell those assets. And we may have to pay for research bought by the fund manager. The name of the game for the fund manager is to take the size of the fund, and by growing the fund, they increase their fee. The size of the piggy bank in this picture is the total size of that pool of assets, and that's called assets under management. The larger the AUM, the larger the fee income. To work out the annual income of a fund, we just take their assets under management and we multiply by the annual fee. So say we've got a 1% annual fee. How much money will the manager make? For a tiny fund of £1 million, the annual fee would just be £10,000. That's not enough to be viable. Even a £10 million fund will only generate £100,000. Once we get to £100 million, then we have a viable fund. You'll see that some of the larger funds are £1 billion or more, and for £1 billion under management, you'd earn £10 million a year. So those were the ongoing costs that you pay every year. The other thing you have to watch out for are entry fees and exit fees, but these are becoming increasingly difficult to justify. In this FT article from 2016 by Naomi Rovnick and Amy Williams, they compare the cost of investing for 4 platforms. You can see that for St James's Place, the initial charge can be up to 5%. Then every year you'll pay the ongoing charge of over 1%, and in the case of Brew and Dolphin, almost 2%. You may also have to pay transaction fees. Then if you decide to take your money out, you may have to pay an exit fee. Again, for St James's Place, you may have to pay 6% to take your money out. But this is only for the first year. This exit fee falls to £0 in year 6. So entry and exit fees are something you should be wary of. So now we know how these funds generate income, let's look at the fees on £10,000 invested in one of 6 robo-funds. The cheapest for a £10,000 investment is Money Farm. In order to grow their funds under management, they've waived the management fee altogether. So all you pay for are the funds that they buy, and these are very cheap exchange-traded funds. Each year, you just pay 0.25%, that's £25 on a £10,000 investment, and that makes Money Farm the cheapest robo on the market at the moment. Nutmeg has produced a simplified product called a fixed allocation fund. The idea is they produced a very simple portfolio, one that you can just leave over an entire business cycle, which will actually fare very well. Of course, they rebalance it over time, but that costs very little from their point of view. So every year you just pay 0.45% or £45 on a £10,000 investment. If you go for a fully managed fund, where the Chief Investment Officer Sean Port and his team of 10 asset allocators tweak the allocation all the time, there you'd pay £75 a year. Next up is Wealthify. This robo-fund, based in Cardiff, would charge you £67 to £87 a year. That's split into £17 for the exchange-traded funds and a management fee of between £50 and £70 a year. The only robo-fund which has an entry fee is Wealth Horizon. You'd pay 0.25% or £25 to open your £10,000 account. Then every year you'd pay £18 for the exchange-traded funds and £75 management fee to Wealth Horizon. Scalable Capital will charge you £100. That's split into £25 for the exchange-traded funds and £75 for their management fee. And the most expensive of the six is True Potential. They'll charge you £76 management fee plus £40 for their platform, a total of £116. For two of these funds, Money Farm and Nutmeg, the fee that you pay depends on the amount you invest. So the teaser rate from Money Farm, if you invest between £0 and £10,000, doesn't apply if you invest more than £10,000. It goes up to 0.6% if you invest more than £10,000. Then it falls to 0.4% above £100,000 and goes to 0% if you invest more than £1 million. Remember, you pay 0.25% on top of this management fee for the exchange-traded funds. And finally, for Nutmeg, anything above £100,000, the fee goes down to 0.35% for a fully managed portfolio and 0.25% for the fixed allocation portfolio. And of course, there are no entry fees or exit fees, no direct transaction fees, and no trading fees. Remember, this is not a recommendation. If you want investment advice tailored to your specific circumstances, seek independent financial advice. Do you think fees are too high? Have you been burned by hidden fees? Tell us, we'd love to know. Tweet us at PensionCraft, message us on Facebook, and if you like these videos, subscribe to our channel.